Hey, everybody, thank you so much for joining us today. I know there's a lot going on in the world and in the great United States as well, and we appreciate you taking your time with us today. Having a great presentation and a great individual, Biff Baker, going to be sharing some insights on the RPM product. And first, from Sunrun Group, on behalf of myself and I'm guessing Biff Baker as well, we want to make sure everyone's safe and healthy. And everything going on there is really, it's concerning, but we can still step back a little bit. We need to still help individuals meet their retirement goals. And those conversations are still helping in the way of everything going on. And today, like I said, we have Biff Baker with us today. And if you've not heard him and I have a webinar, this is going to be a great presentation for you. We both come from a very similar background, starting our careers out with IDS and American Express Financial Advisors. And Biff went on furthermore to be executive level with Lincoln Financial Group and Phoenix Life, slowly going over to the Sabres Partners and leading the life and annuity channels with that and helping business development. So helping you, the agents and advisors in the field, bring an extraordinary program, not just this one, but a lot of things coming on. But the one we're going to focus on today is Buy the Baby Boomer Reboom. This program right now, folks, is one of our hottest sellers. Consumers across the country are gobbling this thing up. The Retirement Plus Multiplier Annuity is a fantastic. They have the motif. They have so many things on here that differentiate themselves. And while the markets were going down and different FIAs were probably not seeing the biggest gains possible, this program right here, folks, this is a must-see and a must-have inside your portfolio. So I don't want to take any more time away from Biff. Go ahead and take it away, buddy.
All right, Tim, thank you so much. I appreciate that kind and warm introduction. It's such a great partnership that we have enjoyed together, ACL/Sentinel, and I'll explain that in a second, guys, but and gal, that may be listening. But let me echo, what Tim just shared in terms of our gratefulness for your attendance today, but also more importantly, perhaps, what it is that you do for those people within your communities, your prospects, your clients, how you're able to help them. Perhaps, as I know most insurance agents anyway, it's kind of in our DNA to help people on many different levels, and it's not always resulting in a sale, but just being that good Samaritan, being that good person, the good friendly neighbor that is helpful to our communities. And I applaud you for being that person. And I am ready to share with you, something that we've been very excited about. As Tim just shared, it's been a very hot seller. In fact, our sales throughout the beginning of the pandemic have literally doubled month over month. So, it's pretty exciting, but it's also obvious that what we have to share with you is somewhat unique. It enables you to differentiate yourself among other advisor competitors. And at the same time, it is warmly embraced by your prospects and clients. And I know this is a very difficult time, particularly to be prospecting in spots where, we still have shelter in place laws. I live outside Philadelphia. Unfortunately, I'm in the worst county in Pennsylvania. So we're still in a lockdown state, believe it or not. But those of you that are not, I'm sure gratefully, you're able to meet clients face to face, but I'm certainly aware that the industry has changed and sometimes for the better. And of course, ACL and Sentinel have the tools that can enable you to work remotely and successfully with e-apps, in particular, as I think about it. So while the presentation is, as you can see, branded by Atlantic Coast Life in the upper right-hand corner, Atlantic Coast Life and Sentinel Security Life have common ownership. And there are reasons why we would use one carrier versus another, and it's really predicated upon the state, and I'll be sharing that with you in more detail. But suffice it to say that the product otherwise is identical. The Retirement Plus Multiplier product is identical. So without further ado, and it's also apropos, let me just say, that where SpaceX, just had a launch last weekend, it's almost apropos that the graphic here is showing how it is that we can help your baby boomer clients, sort of project, if you will, into the sky as it relates to their investments and specifically protected investments, which is what we're all here to talk about. So One of the unique and differentiating features is that we have a 5-year FIA product. So a very short duration. We do offer 7 and 10-year versions of the product as well. And it's a very transparent product in the sense that fees, caps, par rates, all of that are common throughout the 5, 7, or 10-year durations. The only thing that changes actually is your compensation. It goes up with the longer durations, okay? But most sales, honestly, are occurring in this 5-year product. And why would that be? Well, clearly, a short duration is attractive to a lot of people who are wanting to have that opportunity to create flexibility when they can, what I call, stick their head out of the hole and look around at the end of this 5-year period and try to determine, what might be the best thing for me to do at that point. Maybe they need to go to more of an income type product. I would tell you that obviously this product is more geared toward growth, okay, though we do offer an income rider. It is definitely focused on the growth component. And so we want to give your clients that flexibility to be able to make changes in a shorter duration. That's advantageous, obviously, to you, because I asked the rhetorical question, when is 6% commission greater than 8%? I figure in a lot of 10-year products and maybe income generating products, you're probably getting maybe close to 8% compensation, certainly 7.5%, right? And this product for the first time arguably is handsomely compensating you at 6.15% on a 5-year product, very competitive. But 6% is greater than 8% when within 5 years or 6 years, within 6 years at least, okay, you're able to actually potentially make 14%, right? So the huge advantage there. We have a unique index that we're going to be delving into in pretty decent detail. It's run by Goldman Sachs, and it offers up to a 200% par rate. And even in the face of this both volatile marketplace and lowering every day, I mean, almost getting to negative interest rates, right? Our cap and par rates have remained very steady. So I call it taking sort of a Walmart approach, and we're not knee-jerk reacting, if you will, so to the markets. To the extent that we're able to keep things as high as they are, we will do so. So these caps and par rates on the S&P did come down a little bit, but you can see that we still have up to 7.5% on a S&P 1-year point to point. I alluded to one of the riders. I'll get into more of that. We do have a 3-year index. That 200% par rate is based on a 3-year point to point, and some people that may give a little bit of pause too. And so what we try to do is comfort clients in at least knowing that should they, God forbid, move to their permanent address too early, okay, and say during that 3-year period, we would actually credit whatever the index would have been on that date of death. And that's a very sharp contrast to most annuity products where what the beneficiaries receive is what the value is as of the last crediting date. So if you're in year 2.5, as an example, and the client dies, whatever the value of that index is on that day, even though it wasn't fully credited, is what it is that would be passed on, to the beneficiaries. So hopefully that would ease some woes. And this year we added waivers for both nursing home and terminal illness. So other features real quickly, we have a base contract. We offer up to age 85. The base contract has no fee. We have this unique Goldman Sachs Aging of America Index that I mentioned, the S&P 500, and a fixed account. And as far as the riders go, I mentioned that there is an income rider available. I would candidly tell you that if somebody's looking for immediate income, there are better alternatives out there. But for someone in the 65 to 70-year range that is looking to wait maybe 5 years, this could be a competitive rider. But more often than not, what we're seeing is the growth benefit rider, or otherwise known as a buy-up rider, being attached to actually the majority of contracts that are coming in today. More on that in a moment. And then we have, of course, free RMDs, a question I'm asked often. When I think about IRAs or qualified plans or required minimum distributions is, what about inherited IRAs, and we do accept those. And in fact, there's a great FAQ that we have that Tim and the team at Sunderland can provide to you. I'll share it with you in a moment. As far as liquidity goes, 5% free beginning in years 2 and on. I know that there are other carriers, of course, with longer duration products that might provide a higher amount, but keep in mind the majority of the sales are occurring within 5 years. Okay, so fairly short duration. That base contract, and when I attach it to or looking at the Aging of America Index, which is the first group of boxes that you see there, we have a 3-year point-to-point at 140%, or the 1 year at 75%. The S&P is currently at 5% cap, or 32% par rate, and the 2% fixed account. All of that without any fee, right? Now, the growth buy-up rider, this is what I talked about in terms of transparency, it's 1.25% fee, regardless of duration. So 1.25% buys up, as you can see, that par rate on the 3-year point-to-point from 140 to now 200%. The 1 year going up to 125%. The S&P up to 7.5%, or a par rate of 47%. That income rider carries a 95 basis point charge, and the rates are identical to what the base contract, no fee contract would be. Important to point out that one cannot have both the income and buy-up rider on the same contract. So if there really were someone to look at this from an income rider perspective and a growth perspective, you'd actually have to split the sale. And let me point out that we do accept sales down to only $5,000. And also, I'll point out that anything below $10,000 requires an e-app, so no paper apps at those low levels. Okay, but it's really a good time. When I think about Roth IRAs or even regular IRAs, where people are starting to get back into doing their taxes, right? If they've postponed doing them until the due date in July, if they're thinking about that, this could be an excellent opportunity for them and you to get started in something and sort of get their toes wet, right? Thinking about just $5,000. You can see that the compensation increases, as I mentioned, 50 bips based on the duration, and then it does lower at the 76 to 80 and then 81 plus. Okay. I also want to point out here that Atlantic Coast Life pays 6.15%, as you can see on the lower left-hand side on the 5-year. Sentinel Security pays 6%, so there is a difference there. Otherwise, the product is identical. And the reason that Sentinel's at 6% is that they do offer the opportunity for a trip. I will tell you, it's very difficult to qualify for the trip. Only the top 25 people get to go, and it would take normally about a minimum of $3 million in production just to get into the contention, if you will. Okay, so I'm not trying to discourage it. It's up to you, but more people than not probably would choose to take the 15 basis points, greater comp, right? I probably would. All right. So I really want to get into the unique Goldman Sachs Aging of America Index, and it's all predicated upon what it is that we know with respect to baby boomers, right? How rapidly they are turning age 65. We've seen that this is happening at the rate of 10,000 boomers per day. All right. We know that there was a huge increase in population, and it will in fact be up to 70 million by the year 2030, an enormous increase. So this was the backdrop upon which Goldman Sachs looked and said to themselves, well, what's the theme here? Where will these people be spending money? If we can look at this cohort, is there a way to create an index that is literally forward-looking as opposed to just looking backward and hoping that this index might do something like it did in the past, right? So the way to, I think, the best describe this, and I find this, by the way, to be a very relatable, easy conversation with a client, right? They can get this, not some obscure other index, if you will, where they don't understand what is this thing, and I would venture to guess even that the majority of your clients couldn't name even 50 stocks in the S&P 500, okay? So I'm not trying to poo-poo the S&P 500, mind you. I'm trying to illustrate why this Goldman Sachs Aging of America Index is a relatable concept. And really what we think about when we look at these baby boomers, if you had known that 70 million people were going to be hitting the earth in the United States over this 19-20-year time span, okay, would you have purchased the first color TV? The company, Magnavox, or RCA rather, that developed it, right? Or how about Procter and Gamble? If Pampers were hitting, I mean, every mother on earth wanted to have Pampers, right? Not have to deal with the service of having diapers laundered and returned. That whole dilemma. Quick, put it on, throw it away. So Pampers obviously took off. Schwinn bikes, the Ford Mustang. You kind of get the idea. These were all backed by companies that, because of rising utilization, the value of these stocks increased over time. So clearly, if you can look back and say, well, obviously I would have bought those things, right? I mean, who would not answer that question positively? Had I known that, these items were really going to take off, I would have invested in those companies, right? And so that was really the logic behind, well, if we know where it is that these folks have been, now it comes to, where are they going to go? And that's what I mean by having a forward-looking index, and it's very easily relatable. Now, we already know this is the subset of our American economy that control the money, right? They have a lot of money, and we also know that there is going to be a tremendous increase in where that money is being spent. And in some regard, it's unfortunate, okay, that some of this money, actually a lot of this money, is having to be spent in these following areas. I call it the 5 Ps, okay? And when you think about prescription medications, 80% of people over age 65 experience or will experience a chronic illness. Chronic illness isn't going away. And the timing today is actually remarkable from the perspective of investing in this index, okay? Because it is predominantly focused on healthcare and real estate, okay? And that real estate meaning those places where the people in this cohort are going to be spending time. Now, that could be an over age 55 community, okay? And it could also be an assisted living facility, right? Actually, assisted living facilities have become, like a demand product these days. I mean, they're sprouting up all over the place. And in spite of, the pandemic, and, we know what, the toll that it's taken on the lives of the people within those areas, they are growing just by nature of the fact that we have these baby boomers aging at such a rapid pace, okay? So when I think about just backing up to prescription medications, I mean, that we see a federal government that is paving the way, removing barriers for these pharmaceutical companies to come up with a vaccine for the COVID-19 virus, right? But at the same time, so many other things are being utilized or I'll say pumped along. They're trying to hasten the development of various prescription medications, not just for COVID-19, but when you think about genomics and how technology is having a bigger play, more so than ever within pharmaceutical companies, how the speed of delivery is increasing, all of that should translate to increased revenues for these drug companies. And if, like we just discussed, if you believe that increased revenues, meaning when you think back to RCA, Ford Motor Company, during those times from 1946 to 64, okay, that if increased revenues translates into increased stock values, then you want to be in a healthcare related index. because we know unequivocally that people are going to be spending money in this space, and that's why it's forward-looking. We don't have to hope. We know where these folks are going to be spending money. Premiums points to things like Medicare supplements. So could we be capitalizing on companies like United Healthcare, as an example? Okay, the places I just talked about, and then products and procedures. So we are living longer than ever, for sure. I mean, in fact, the couple that are age 65 today have a better than 54% chance that someone will be alive at age 95. So, we're planning, as you know, for like 30 years of income. And when I think about this, I've seen over the last decade, and I know you have, and some of you have participated in it, an amazing proliferation of GMWB sales, right? And particularly to the folks that don't have a lot of money, it was a huge boon to them, right? They were living with extremely low interest rates, even a little bit higher than today, but they were 1 or 2%, okay? And you could show someone how they could increase their cash flow, maybe 5 or 6 times, right? And people jumped on that, and it was fantastic. But if we know that people are going to be alive for another 30 years, are those same clients going to love us when they see that their income is static? It's locked in. So we kind of owe it to these people to at least peel off a piece of their assets and put it into an opportunity like the RPM product that can give you that growth component. And again, as I had said earlier, create the flexibility to address what the changing needs may be down the road. Okay? And it just gives you great opportunity, particularly when I think about a time like today where, we were sheltering in place, and who were we going to talk to? We couldn't run seminars, face to face. Many of you were doing webinars like this and inviting prospects to it. But your existing clientele were the ones that you needed to stay in front of, right, to keep calm. Okay. We know this, annuities create stress-free lives, right? I mean, this. I mean, it's not unique to RPM. Zero is your hero, right? Okay. But it's a fact that people that own annuities have much lower stress levels than people that are subjecting themselves to the whims, if you will, of a stock market every other day and not being 100% certain that their minimum subsistence levels are being taken care of, right? So I'm not saying don't use GMWB riders. I'm saying peel off a portion of it, put it in this growth prospect, okay? Put the rest in the income rider if that's what they need, okay? But give people a shot of keeping pace with inflation, right? So products and procedures, and even though we're living longer, we're not necessarily enjoying better quality lives. I've talked about chronic illness, but also, our bodies begin to wear out over time, right? And I'm sure you're aware of many people that have had knee replacements or hip replacements. So are there companies, if you will, specifically that we could be investing in, forming as part of our constituency that are prominent in those areas, okay? So what I have here before you is a list of the top 10 constituents of this unique Goldman Sachs Aging of America Dynamic Balance Index. It's a mouthful. I just call it Aging of America for short. But they're very well-known names, many of which are, they are in the S&P 500. But you can see what the specific area of innovation that these various companies are focused on. And when I think of, Johnson & Johnson, who have obviously been in the news, and there's been a little bit of negative news, right, as it relates to baby powder, okay? But they're the largest manufacturer of hips in the world, okay? So replacement hips. So, it's logical to presume that they will get through this time, and they will also move forward, based on the orthopedic care needs, and therefore continue, in my view, to generate strong revenues, right? I mentioned United Healthcare Group for, Medicare supplements, okay? And I don't need to read the list. And in fact, I'll show you where you can obtain the list in a moment. But suffice it to say, we're looking at the largest, most exposed companies, if you will, that are going to benefit specifically from this cohort, that being the aging baby boom generation. So simple thing to explain. when I look at illustrations, and you know this better than I do, everybody's illustration, no matter what carrier, has to show you back-tested performance, okay? So as much as I like to say I have a forward-looking index, okay, we are required to show you what it looks like, historically, right? Should it have existed? By the way, this index was created and came out on August 15th of 2018, okay? But really what I'm trying to share with you is the contrast. Like, why does it make sense to pay 1.25% fee? And you just look at that 3-year point to point, and that return through 10 years ending in 2019 was 8.58%, and that's net of the 1.25% fee. You can contrast that to the no fee contract, and it's 6.21%. Which one would be better? Okay. But even the 1 year, 7.18%. And many people, by the way, when they structure their illustrations, choose to put a percentage in the 3-year, a percentage in 1 year. I've seen them where they put a percentage in the 3-year index and a different percentage in the S&P 500. Okay, I'll show you some reasons as to why they may do that are just beyond, trying to create balance within a portfolio. Okay, but clearly it makes sense that the 1.25% fee be paid on a back-tested basis to generate returns that are substantially higher than the no-fee contract. Now, when I look at this, and then looking at those 3 boxes, least favorable, most recent, okay? This, again, is through 2019, okay? The point that I'm trying to make for you here is look at the consistency level of this over those 3 boxes, okay? The Aging of America Index has the ability to produce smooth returns over a long period of time. And it's because of the application of what's known as volatility control, okay? So there is a momentum signal. It's a 5% volatility control. And that momentum signal, when it gives off the signal to say you need to not be in this index, but over in bonds, okay? That's where the trigger occurs. And that's what we're paying, if you will, Goldman Sachs to do. Say, well, when do I want to be in this index? When do I want to be in bonds? Or what should the ratios be between the 2 different scenarios? And then also cash, okay? But you can see that this managed, I'll call it volatility control, managed Goldman Sachs index, even in the least favorable time period, returned more than 2 times what the S&P did over that exact same time frame. Now you could say, oh yeah, but look at the most favorable. Yeah, the S&P that's true. But none of us has that crystal ball. So the point is that we have a good, stable, relatable index that clients clearly grasp, and I'm hopefully sharing or making sense that we know, arguably for the first time, where it is that people will be spending money. The only thing that you and I need to agree on is that revenue, as it comes into these companies, and as innovation occurs, because the government is lowering the barriers to enable these companies to develop the things that we need, okay, from a drug perspective, all right, prescription drug perspective, all right, more quickly, enabling them to come out with it more quickly, that should all translate to increased revenues. Increased revenues should translate to increased stock values, which translates to better performance for your clients, okay? So throughout the year 2019, the Aging of America raw performance was 11.04%, okay? That's raw, meaning before the application of a par or cap, okay? And you saw that those par rates are pretty attractive at 125 with using the buy-up rider, or 200% for the 3-year, okay? So really impressive performance. And here's the volatility control basically. So in effect, that's what we're looking at, okay? That constituency, which I had shared with you, and then those momentum signals, which is telling Goldman through their algorithm, okay, when should I be tracking the index, if you will, from an options perspective, or when should I be more greatly invested in the fixed income? And what that has enabled us to do is actually have positive performance year to date, okay? I'm going to share something with you real quick. In fact, I'm going to jump there right now. I mean, this is something that I do every single day. okay? And that is to go to this site, the Goldman Sachs Indices.com site, and I can pull up this actual index. Now I can see that it was down 39 bips, 35 basis points yesterday, okay? However, I can look at what this index is doing every single day at this site, okay, this specific index, and I can see here that the performance year to date, okay, even on an off day, is 2.56%. 2.56%. I'm only concerning myself with this first column. This column, annualized performance, that assumes, it just takes the first column and assumes that it's static, and if it duplicates itself through compounding by the end of the year, it would have equated to 6.2. I don't find these things very meaningful. Most of these other columns, I want to know, what has it done year to date? It's positive, 2.56 over 6 months, over 1 year, okay? Let me look at what has the S&P 500 done. In spite of the fact that we've had the biggest sell-off ever, right, in terms of how quickly it happened in March, and now we're seeing a tremendous bullying of the stock market, it has yet to achieve break-even status from the beginning of the year. If I look at the S&P 500 as being that benchmark, and you can see right here, year to date, the S&P 500 is negative 3.62. That is a compelling story. And I have the flexibility of changing this graphic and all that, okay? I mean, have the scale and so forth. There's good information here, the fact sheet. If you really want to be a super technocrat, okay, you can read the fact sheet and the methodology. You need a degree in mathematics for the methodology, honestly. Really, what I think most people want to know is what it is that we've been sharing with you, okay? Will you invest where it is you'll be spending money? Doesn't it make sense? You know where these people are going to be spending money. Let's grow with them, okay? Go back to this presentation real quickly, and I'll come back to this. So I did mention earlier that there are two carriers ACAP owns. American Advantage Capital Holdings is the private equity group that owns both carriers, Atlantic Coast Life and Sentinel Security Life, okay? And so there are states specifically where only Sentinel can be sold, and it's because ACL doesn't have a charter there, and vice versa. Okay, so as you can see represented in the green, California, Idaho, Minnesota, these are states that we have to use Sentinel, and that's 6% compensation. Okay, with the navy blue, you can sell either carrier, but remember ACL is at 6.15%. Okay, and where there's light blue, only ACL can be sold. Okay. And unfortunately, you know, in the New England states, it's not approved in the majority of those states. Okay, those are states that we continue to work on, but you know, we would certainly apprise you through Sunderland the moment any changes occur. All right, but that's the grid as we know it today. I'm going to demonstrate for you the ACL website in a moment, but we have a complete set of marketing capabilities available to you. A great client brochure and explaining what the index is, like I've shared with you throughout this presentation. The product facts, if you will, an excellent FAQ I mentioned, and also a sort of a fact finder, I'll call it, that is many of you would find beneficial in terms of not only explaining the index, but also learning where your client's head is. You know, how do they feel about the future, you know, with respect to inflation, with respect to the markets, that kind of thing, which helps you to set up the solution, being the RPM annuity. So in conjunction with the good folks at Sunderland, where I certainly would tell you to rely on them first, we do back them up. If for some reason you're not able to reach someone or you needed something and you wanted to just call us directly, feel free to reach out to us at 800-447-4312. We'll provide you with the data and materials that you're looking for. So anything that you need, we'll run an illustration for you, get you the application material, whatever you need, okay? I did mention I'm going to jump to the portal. We do have an online contracting platform, which does provide you the opportunity, if you're not already contracted with ACL Sentinel, You could literally do it. Sunderland can create the link for you, send it to you, email it to you. You can complete that, and within about an hour, you will have access and the ability to literally make your first sale via e-app today. Okay, so that's a pretty slick program. Okay, so in fact, again, let me go back here to my famous portal. If I could just open that. Here we go. Okay, so this is what the portal will look like. Okay, and you can track clients, not only pending business, but in fact, you can download the policy now from the website. Okay, so the policies are uploaded to the website. They are still physically mailed to a client, but a client can download it. So you can give client access to this basic website, okay, in their own name with their own code, obviously, not an agent code, but they register on the site as a client. They can download the policy. So that's a pretty neat and innovative thing, if you will, that has occurred as a result of the pandemic. So good news there. So from here, we can run, well, this is where we would get those documents that I was referring to a moment ago. And then we can run illustrations. So I just took the liberty to run a couple of illustrations real quickly that I wanted to share with you. Okay, so this one, let me back up. I hope I'm doing okay on time. This one is, I'm assuming 100% of the money going into that 3-year bucket with the Aging of America Index. Okay, all right. Now, if I look at this page, okay, and just looking at most favorable, it really doesn't matter which one, but if I see at the end of the first year that my account value went down, this one has the buy-up rider, and you will recall it's 1.25%, and nothing has been credited to the account, obviously, right, until the end of the third year. And that's why I see 118,972, 23.5% has been credited to this account, okay, at the end of the third year. Some of you may feel like, I don't want to have to go back and resell this to my client, right? Maybe they won't remember. Like, they'll say, well, why did it go down in value? I thought you told me 0 was my hero. And it's because obviously the fee has come out, but nothing's been credited. That might be a reason, right, to blend the investment components within this. And maybe what we do is put some of the money in the S&P 500 or in the 1 year, okay? And that gives us a shot, at least, at having a positive return, okay, showing on that annual statement, so to speak. But another thing that we can do, okay, is, okay, some of you may be thinking this, like, okay, well, what happens if at the end of 3 years, okay, this 3-year index doesn't fit with a 5-year product, like so for the next 2 years, even though I can leave, I didn't get anything credited, right? And that's true if all you did was the 3-year index, okay? But what we have from an illustrative perspective, okay, is the ability to check a little box that reads strategy to duration, okay? And so what's happening here is that while you see zeros in those first 3 boxes, okay, it is automatically shifting at the end of 3 years to the 1 year point to point. Goldman Sachs Aging of America 1 year point to point, and that's why you're seeing a positive return here. Okay. So here's the 3 year just alone. Okay, and you see I have to wait 6 years. It pays off in this example, right? Okay. But again, for those clients that might be skittish about this, that might be willing to accept perhaps a slightly lower realized return, we have the flexibility to be able to show them how just shifting, if you will, from the 3 year to the 1 year is capable. Plus, of course, we can put the money in the S&P 500. This one is I believe, if my memory serves me correctly, this is 100% in the S&P 1 year point to point with the 7.5% cap. Okay, also including the growth buy-up rider, and we can see that performance back tested is 6.9 on On the 3-year, it was 10%. Now, and then with the 3-year, just to be fair, with the 3-year converting to the 1-year, it's 19 bips higher, 7.09 when I look at the most favorable. Okay. So with that, I did want to share some things, other things with you very quickly. This FAQ, okay, lots of good questions that I'm sure you will have. And certainly, reach out to Tim and the team at Sunderland. He can get you this document. I'm sure he'd be happy to share it with you. The client brochure I mentioned, okay, but this really does a great job of explaining, the roadmap, if you will, for our prospects. The quick sheet. We even have an EAP user guide if you're unfamiliar with utilizing EAPs and you want to give it a try. I mean, this is a pretty intuitive guide and EAP tool that we have available, so easy to use. Let me get back. Give me a second to the presentation. So just in summary, really, we can all see and agree that we have an aging baby boom population. We know that particularly now, healthcare is in vogue for sure, okay? And companies that participate in healthcare are going to be going up in value just because these folks that are our clients are having to use their products and services, right? So it really is arguably the best time to be in our business. We're living through unbelievably volatile times with the stock market. I'm sure that your existing clients are very happy that they know you, that they've worked with you, right? Because zero has been their hero, okay? But could we peel off a piece? Could I ask you to please think of those clients that you have with maybe some other free cash or something that's renewing or coming up for renewal, to take a piece and put it in an index where we know that we've had positive performance year to date. Hopefully I've been able to make a compelling argument. I do appreciate, again, you guys taking the time to visit with us today, to hear about this RPM product. I'm anxious to hear your feedback. We're looking for, I just want to say, thank God you're healthy, you're with us today. And I appreciate all that it is that you do for your fellow neighbor, and both from a financial as well as a personal perspective. And with that, Tim, I turn it back to you. Thank you again for the great partnership that we have with Sunderland Group.
Mr. Biff Baker, thank you very much. I'm trying to see what I can. Want to share a couple of things. You can see my screen now. Again, I just want to say thank you in the audience for taking some time out. I know asking if it's a compelling story, it certainly is. And as Biff mentioned, it's unprecedented times, which we need extraordinary leaders and innovative solutions. Well, we already understand the times, and you're the extraordinary leader out there. And with this solution, it's critical to even just pose it and just have that conversation. The RPM, we're selling millions. We're getting inside of broker dealers. Agents and advisors across the country are gaining, traction from Sunderland Group. And not just with the product, which is fantastic, but a couple of things about your business quickly before we recap this whole thing. SG Pro Shop is your digital gateway. Everything from your marketing assets, a lot of information about our virtual systems and our meetings. That we're not brand new in that system, folks. We've had this for years. So taking away in that huge expense out there, a lot of people saying, well, we've innovated in the last 2 months. That's fantastic. I'm glad people are trying to get into this space, but we've been in here for years. And so take a peek at us with that State of America virtual meeting. That's helping you relate to your customers. Biff mentioned earlier on online meetings, webinars, still some social distancing. We may or may not see, sometimes on TV, but large groups of no more than 10. So again, a great way for you to educate consumers, especially with this RPM product. Online educational workshops, we have plenty of these. Our EAPs and e-policy deliveries are exactly what Biff said today. IGO, EAPs, drop tickets, training, life insurance, Medicare, the whole works. Readily available staff 24/7 if you want to start reaching out to us, especially with our website, our SG Pro Shop. And further information on all of this, you can see that sign at the bottom of that website at the bottom, and it's here on this thank you page, sgadworld.com/COVID. Visit our website, the www.sunderlandgroup.com, and toll free, our sales consultants are standing by, 800-373-9807, option number 2. A lot of material covered today, folks. All of those documents that Biff shared with us, from the consumer brochure to the worksheets, we have that material and want to help you engage your customers with this fantastic product. Last time Biff and I did this presentation, really the pandemic was just starting, and I had to pose the thing, and as you're talking about even just Johnson & Johnson, a major player right across the globe. And as the market was going down, Johnson & Johnson was still maintaining power and trending upward. Obviously, around March 23rd, the markets had a huge correction, if I want to say that. But Johnson & Johnson made a big leap back up. And so the last 6 months, even the last 3 months, you're taking a look at a lot of green going on. Certainly a down here and there, but the stability behind the investment portfolio is really second to none. This is the program, folks, you want to get engaged with. Biff Baker, only the best. Thank you, sir, for helping us out today. You in the audience, thank you for taking your time. Stay safe and stay healthy. God bless.